let the games begin. For those that weren't sure if he was simply just saying it or it became a reality, on Monday, March 3rd, President Trump announced that he was officially going to move forward with the tariffs against Canada. No longer a joke. It is actually set to happen. And by the time you're listening to this, that means it's a real thing and it's actually occurring, assuming he stuck to his plan, which means that you should probably hang out for the next 10 minutes and hear exactly what Trump's tariffs, at least in the short term, could mean for the marketplace. And we'll do a much deeper digest in the coming days and weeks once we determine what that looks like overall for you as a Canadian and as a potential homeowner and real estate borrower and everybody else going forward. Here's what we got. 25% tariff, which is a tax on all Canadian imports with a 10% tax on energy products. Now, remember this, guys, we've talked about this before. A tariff is a tax charged on goods and services that are imported across the border. This will make things obviously more expensive for Americans as it relates to taxing Canadians to get things across the line. The tariffs initially were linked to border security that were delayed to allow for a quote unquote economic deal, but now Trump is just basically saying it's a done deal. There's no negotiations left at this point. What does that mean for Canada? It's basically deja vu, and it's back to steel and aluminum tariffs and fights of the past, but now the stakes are substantially higher than they were before. I mean, we're looking at a potential domino effect across multiple industries, particularly manufacturing, energy, and additional exports. Now, you're going to hear a lot more about this for the coming days, but let's talk about the immediate impacts right after this actually happened, because it didn't take someone with a magnifying glass to look at the bond markets today and say, holy that was wild to see that drop. The markets did not take the news lightly. And basically what happened right after the announcement, the 5-year bond yields dropped 8 basis points to a new 3-year low of 2.52%, and they're going to keep going down most likely. TSX fell 1.54%, which is 391 points, and the Dow Jones took a hit too, dropping 1.48%. We also saw the Canadian dollar get beat up all over again, and we're back down to 69 cents USD. So again, we're here for mortgage rates and real estate. Let's talk about that. Why did the bond yield drops matter? Well, because the bond yields directly impact fixed interest rates, as you probably know, and when they drop, typically speaking, I'm going to say typically because it's not always the case. Normally, fixed rates drop as well. This could be good news for a homeowner or home buyers out there hoping to get a little bit of a rebound on lower interest rates, especially those that are coming up for renewal in the next little bit and those who have locked in for good terms. But it's important to know that many of the banks have been prepared for this to happen, and they are, of course, keeping a little bit of a buffer there to keep their risks as low as possible. What does this mean for interest rates and the Bank of Canada? Well, first and foremost, the chances of the BOC cutting rates on March 12th just went way up. But it's not simple. If Canada enters a trade war, it could very much slow economic growth, which would force the BOC to cut rates even sooner and potentially more than 0.25%. However, here's the thing. Inflation risks in the US could push the Fed to hold or even hike interest rates, which could create a divergence. All of that to be said, this could put pressure on the Canadian dollar, making imports more expensive, pushing up inflation, and bringing us back to this conversation of stagflation, which of course the BOC would have to consider before making those rate cuts. So what will Canada do? I mean, let's be honest here with you. We've seen reactions across Canada from different provinces, and you can argue whether they were strong or not. I'm not here to argue that here today, but Ottawa is not taking this lying down here today. The Foreign Affairs Minister confirmed that Canada will mirror the US tariffs. So this is going to make things more expensive for Canadians. 25% on $30 billion worth of US products immediately. Additional tariffs on $125 billion in goods 3 weeks later. In addition, Doug Ford, as you know, the Ontario Premier, went even further to suggest cutting off the U.S. energy exports altogether, which is a big statement considering how integrated the U.S. and Canada are. That would be wild to see that happen. The question that many are asking is how much real pain does this inflict in the marketplace? And the reality is, since we rely on the U.S., just as much they rely on us, a prolonged trade war is probably not a good thing, and it could mean a massive contraction of our GDP, which people will lose jobs if this were to happen. In fact, they would propose as much as 350,000 job losses between Ontario and Quebec alone. It could be a massive blow to consumer confidence, and it could impact the housing market because people feel less economic certainty, which means less people buying homes and taking on mortgages. But I don't know if that's going to be national. I don't know if that's going to be immediate. It's almost like the boy who cried wolf here. People are constantly shaking their head and not really sure what to believe when it comes to this. So we'll see what happens, how that shakes out. Beyond Canada, the tariffs could worsen inflation in the United States, making the Fed rethink its cut plans. Specifically coming from an economist here, Jocelyn Paquette. She says, the tariffs on China, Canada, and Mexico could accelerate a rebound in goods inflation that is already underway in the United States. Not a good thing there. Companies themselves are already rushing to push shipments forward before the tariffs kick in, driving up prices. And inflation, if it surges in the US, the Fed might have to pause rate cuts or even raise rates. And they're not a good sign for them. And that would make borrowing more expensive for Americans and Canadians. So these potential rate drops might just turn around and become rate increases really quickly if this happens. So let's talk a little bit about what does this mean for Canadian home buyers and homeowners. Fixed mortgage rates right off the bat. They could drop if the bond yields stay low. Obviously, great news for buyers and those coming up for renewal or refinance right now. Variable rates, they might fall slightly more if the Bank of Canada cuts rates, but this really depends on inflation risks and just the economic uncertainty of what's about to happen. So don't expect any quick sudden movements is what we're being told. Housing market itself, if a trade war escalates and job losses continue to grow, we could definitely see weaker home sales or at least flatlined home sales. But a lot of this appears to be most likely centered in manufacturing provinces, more specifically like Ontario. So it's like Ontario and even Quebec will get beat up pretty bad, much more than, let's say, Western Canada or other provinces. Another factor is the inflation risks. A weaker dollar means imports get more expensive, which means groceries get more expensive, gas gets more expensive, and everything goes up in price. My last take on this is with the March 12th Bank of Canada meeting coming up, and the retaliatory tariffs about to kick in the next few weeks are going to be so crucial. In the coming days and weeks, I'm going to be watching for how quickly Canada responds with the counter tariffs. Whether the US economy shows any signs of higher inflation in the marketplace, and what the BOC actually is signaling in its next meeting. Now, if you're a homeowner, if you're in the market for a home, now it's a really, really key time to stay informed. I think more than ever before, being flexible and being ready to take an opportunity would be key. Anytime there's fear in the marketplace, it usually means people hold back and they don't do anything. And of course, if that's the case and you're well equipped, then you can act quickly and get good value. What most Canadians are going to ask, like usual, should I take a fixed rate? Should I take a variable rate? And should I jump into the market right now when there is the fear in the market? I, for one, don't know what's going to happen for sure. Like, I'm not here to tell you I know what's going to happen, but I can tell you this. With all of the ups and downs, particularly the last year, a couple of years, the Canadian real estate market has proven to be insanely and exceptionally resilient in most markets, not all markets, but incredibly resilient. And Canadians as a whole are exceptionally resilient. I wouldn't be surprised to see a little bit of a dip in what we thought was going to be a heavy spring market, followed by a rebound shortly afterwards in not all markets, but many markets, particularly those that are not as impacted based on the tariffs. In the rate market, it wouldn't be shocking to see these bond yields dip and then work their ways right back up really quickly, in the end costing Canadians more money in mortgage and real estate expenses, mortgages specifically rates. We're going to go deeper on these topics in the coming days and coming weeks as more information comes out, because literally we're just doing this on the evening of and hoping to give as much value as possible. If you want to stay tuned, make sure to hit that like button, subscribe on the YouTube channel, and let us know what you're liking about the podcast or the YouTube. See you on the next one.